Okay, I'm pressing the button.
Hi, everyone. Welcome to another market talk. So finally, today we had a bearish price action. XLUI WM is green. Indices sold off, especially in the last hour. So hopefully we will have a lot to talk about today. And yeah, so hi, everyone. So maybe we will start from Brian. So Brian, XLUI WM finally green. So what are your thoughts?
Yes, XLUIWM finally green. That one been hanging in there. Really hasn't done that great for the past week or so, or really even the past 2 weeks. It's just been going sideways. I'm more just waiting on that one. I think once IWM really starts picking up to the downside, which I think we're getting there today, that one should really start to work. And so otherwise, if we're looking at kind of what I'm looking at, let me share my screen here. All right, can y'all see that okay? Yep, great. All right. Yeah, so overall I'm really bearish here. Like really bearish. On February 2nd, I'm marking it as the bear capitulation day. If we remember what happened on February 2nd, if I pull up a chart here, we had and we'll look at IWM because I'm really looking at the Russell to lead a lot of this move. On February 2nd, looking at Raphael signal, you got a sell signal there. It was after Jerome Powell did his dovish stuff at the conference, and everyone thought that Fed was going to pivot, and it was all sunshine and rainbows and dandelions. Let's buy bonds, let's buy gold, let's buy stocks, let's sell dollars, and that marked the bottom in a lot of things from a macro perspective. And so on that day, we saw vols. So looking at fixed strike implied volatilities at the money for IWM go down to the lowest level they were for the entire bear market. And so I'm not really a big put guy. I don't trade them act like that much, but that was too enticing to not go after. So I added some puts on IWM when they were just the cheapest implied vols for the entire bear market. Seemed like a no-brainer. I added those and I got really aggressive on the short side on February 2nd. All of my signals were screaming on that day. And from that point forward, we started selling. I'll highlight what caused a lot of the sell from there. But we started selling that week after that. So last week was great. This week hasn't been great. Today is a good step to get right back on track today. I've broadly been just holding a very large short book and adding here and there over the course of the last week. I didn't cover anything last Friday. Would have been a good play to do so, but there were just too many things flagging for me to the point where I think this thing inevitably really just snaps hard. And February 2nd, I think, remains the best price for going in there. So on February 2nd, after they started chasing bonds, you saw the low in the 10-year yield on that day, and everyone and their mother was getting long bonds and staying bullish on bonds on that day. It was pretty clear, given the consolidation that we'd had then for multiple months, that being long bonds at that point just didn't make any sense. And so many of you guys now have been familiar with the Bond Bull Anonymous hotline that I've been sending out. Here's like the main thing that kind of triggered my brain on bonds and why I'm just extremely bearish on bonds at this time and forward. Okay. I started to think of yields in the light of the 5-year yield, the 10-year yield is whatever the market thinks Fed funds is going to be in 5 years or 10 years. I'm not thinking about it in terms of expectations on growth or expectations on inflation. This is what led me to be a bond bull last year and get absolutely wrecked. If the Fed is hiking rates, it makes absolutely no sense to be long bonds. 0 cents. The 10-year, the 30-year, the 5-year, those traders have no edge in knowing exactly what growth and inflation is going to be like on those durations. So the best information they have is what the Fed is doing on the 3-month and the short end of the curve. And so if the Fed is still hiking rates, the longer ends of the curve will rise. There is no ifs, ands, or buts about that. You're not going to get any edge being long bonds until the Fed stops cutting or stops hiking, and then is close to starting talking about cutting, which won't happen until people start getting laid off noticeably and for an extended period of time. Okay, and even if we start getting equity sell-offs and jobless claims and jobs reports start getting weaker, bonds still won't fully bid until we get a commitment from the Fed that they're going to do that, because they're just going to keep selling. And on top of that too, in order for the recession to actually come, the yield curve has to uninvert. And that's not going to happen by the 3-month and the 2-year yields falling. That's going to happen by the long end rising to where the 3-month and the 2-year yields are. So that's a macro perspective that really changed me on bonds. So I became extra bearish, and I started looking for where they were in MFR, and MFR led the complete move on yields. It flipped fully bullish. I want to say, I don't know, you can correct me by Raphael, but over a week ago, it flipped fully bullish, and it was already neutral and flipping here. So it was very clear that bonds were about to get absolutely wrecked. And my way I expressed that was via short BNDX. So I like shorting European bonds. There's no like, if US bonds get whacked, European bonds are going to get whacked. There's nothing changing there. And the ECB is still hiking rates. So I like shorting their bonds. And there's a lot of blow up risk there because they're just worse bonds. Eventually, one day the treasuries will catch a risk off bid. That's not anytime soon, until we get to the point where yields, and especially real yields, are falling with the stock market crashing, which would be an actual deflationary scenario. And we're not even close to deflation. And people were longing bonds down here when the market was cutting in a ton of hikes this year, which we're not even close to at all. Even if labor was deteriorating, we're still not even close to cuts, which is what the bond market was pricing down here. So it was absolute insanity to be long bonds here. It's also absolute insanity to be long gold too. So gold, I really used a lot of Raphael's signal to help with this. It was signaling heightened volatility around here, as well as a potential breakdown. So that was very helpful, but also the same macro perspective that gets me short bonds here and through that move got me short gold. And alongside that, it gets you long, aggressively long dollars. Okay, if you look at IEF UUP correlation, this one is firmly negative. Dollar and bonds are trading inversely correlated, and that thing is growing aggressively. So you cannot be a bull on dollars and a bull on bonds at the same time here. It makes absolutely no sense. And so from that, what we got from the February 2nd capitulation day was a big move up in dollar, which I'll tell you, I was a bag holder on dollar from around here. So, you know, I've had a very large position that I just decided to hold through because I knew we'd eventually get to kind of where we're at now, where inflation is sticky. The Fed isn't cutting anytime soon, and dollar would eventually bid. So I think Raphael can talk about, you know, where he thinks the dollar from here. From my perspective, in MFR, it's neutral trend shifting back to bullish. Hearst exponent strengthened aggressively on the dollar yesterday, went from 0.58 to 0.7 today. We'll see where it's at in the morning when we get that update. So this move up on the dollar should stick for me. So we closed green yesterday. We closed green today. We should close green tomorrow. I don't see anything from a macro perspective at this point that should cause any kind of trouble for the dollar. Dollar yen is leading, which is also a bad sign for bonds too. And it also highlights, since if you look at where dollar yen bottom, people are talking about long in the yen here, it's absolutely crazy. Dollar yen bottomed back in January, and it's just slowly been going sideways, and now it's really going up here. And that one's been bullish in MFR, I want to say, for a while now. And that one just highlights incremental hawkishness from the Fed, which was really building up here, which caused a really just huge rise in bond yields. I mean, this has been one of the most aggressive moves in bond yields since August to September. And what's really interesting, why I'm even more bearish now on stocks here, was you've had this huge move in bond yields, but stocks, if you look at broadly S&P, for example, have gone nowhere since that move really started taking hold after February 2nd. And why is that? In my opinion, this is speculation, but just looking at the action and looking at what's happened with volatility. On February 2nd, you had your big bear capitulation day. That's very clear by the subsequent action in the dollar, as well as the subsequent action in bonds, as well as in gold. All the bears that were, bearish those, because that's what didn't work last year, flipped, not only from a short selling perspective and covered their shorts, but they also started going long, and then they started, selling those things, right? And so then you got pressure against them there. And then on that day, though, you had a lot of volatility that was bid up into the CPI report. And I think they all committed to that day, we're going to unwind our hedges. And so now for 3 days in a row on the S&P 500, we opened red and bid up to what I have as a 1 standard deviation move from open to close. We get to that level. The last 3 days, it closed at green. Today, the call buying got too exuberant and it failed. It failed like a dog. So if we look at QQQ here, for example, it might get a little skewed here based on the close, but I'll show you what I was looking at intraday if this wants to work for us. Yeah, so we're good here. So QQ intraday, they were chasing 310s, and this isn't about zero DTE. I think the zero DTE craze, that thing is peaking as well. Whatever option duration they were doing, it doesn't really matter. They were trying to get 310s and really loading it up both on a call perspective to the point where 310 became the absolute gamma strike intraday. And so that showed just a real craze, and we weren't able to get there today because we opened so low on S&P. So a 1 standard deviation move wouldn't have gotten us to 310 QQQs, and it couldn't even get us to 195 on IWM, which is what they did the same thing. So what you saw into the close was they couldn't get to those strikes. They pressured the market lower, and big call selling came in to the point where Q's intraday was, I want to say it was up to 20 or 30 billion of positive gamma notional. And then that means 140 billion of notional was sold into the close. That's from a perspective of puts being added, which you saw with the VIX going up, as well as calls getting dumped too. So where we're at now, we've broken down back into negative gamma. So that's a great sign. And then from a correlation perspective, stock bond correlations on the meat of the curve here are ticking up. Sector correlations are strengthening as well. Dollar is trying to get back its negative correlation. Dollar bonds is firmly negative. Those trends are going in our favor. And Hearst across the board is strengthening as well. So I'm extremely, extremely bearish right now. And I'll say, listen a lot of you guys listen to Jem, whatever you want to call him. He's talking about those flows that we saw from the systematic unwinding of hedges since the CPI report to fade into tomorrow, which we saw today. So I think this market absolutely pukes. I think the dollar bids very hard. I think bonds continue getting whacked. I think gold gets whacked. One interesting thing about gold I have seen, we'll see if this changes in MFR. I mentioned it to Vi before the call got started, but the long-term range is at 0 here in terms of its difference between the near term and the long-term range. And if you look at dollars to the upside, I don't know if this changed the other day, it was showing the same. Dollar to the upside was the same. So I don't know if that means we're capped. Maybe that's a bad sign that the market's really going to puke here, or if that thing's about to change. Maybe Vi can touch a little bit on that. But that's one slightly concerning thing for me. But I like how XLU IWM bid today. I like how high beta, low beta, and I'll wrap up here soon. High beta, low beta, SPHB over SPLV. That thing sold. That thing sold into the close, and what you can see as well is that one's strengthening a positive correlation back to SPYs. It actually, that one rallied over the last couple of days, which made the squeeze kind of harder for me over the last couple of days because I'm short a bunch of high beta stuff. But that one weakened its correlation to SPY over the last 2 days when high beta was squeezing, and now into the down move across broad stocks with sector correlation strengthening, it strengthened its correlation. So I'm about as short as I've ever been right now. And I hope it's going to work out. So we'll see, but that's where I'm at, guys.
Yeah, so refreshed numbers for gold still show that long-term and regular-term downside is the same level. Yes, absolutely, the same level. And for that to change, we need quite significant changes in volatility right now. Okay, so Brian, maybe you can stop sharing your screen. Yeah, so let's continue with Christopher. So Christopher, what about those recession probabilities? Are they still low?
Yeah, in case for the recession probabilities, we are still very low, especially for the US. we're seeing this with the inflows and the deficit spending and rising rates. It seems like the economy at this current state is really pretty strong, in my opinion. So even if we are still in disinflation and the growth probability is low, based on my market models, I don't think that we would see that kind of a bearish move in the next months. So basically neutral at this time for the US. But what I would like to focus on today is Europe. So I will share my screen. I prepared some slides. So what you can basically see here is my assessment of growth probability on the left side in the chart. So I actually try to improve the models. I cut out some volatility, use some data science stuff to get rid of dimensionality, and the result is pretty good in my opinion. So what we're at right now, so we're basically at 50% for Europe. This you can also see on the right side where you look at the regime outcomes, growth and inflation regimes. So the most probable regime is currently real growth for Europe. This switched back like in 1.5 weeks ago or something like that, and you can see the stock reaction to it. So it basically trades within GDP momentum, which you can see later, which I added to the models. But overall, markets are kind of confused. So in my opinion, especially in Europe, we have rising rates. The government is still in a heavy deficit. It's last time I checked, it was at minus 3% of GDP. So they're still creating money based on that, which supports the private sector and supports the economy, stabilizes it. Even if retail sales and especially consumer confidence are falling, this lifts it up, especially if we look at GDP as a growth measure. When you look at this next slide, so you can see on the left side, you can see the relationship between the year-over-year growth rate of the European index and GDP momentum. GDP momentum is based on this market signal approach, where I look at 42 factors, comprise them, aggregate them. And what you can basically see is that it trades pretty good, especially in the last 2 to 3 months. You can see the rising GDP momentum, which goes from -5 to actually minus 0.5 to plus 0.5, which is the 3 months difference. I describe it that way. So you can see the correlation is pretty decent in the last 3 months, which drags up stock performance, in my opinion. And as well, on the right side, you can see the dominant regimes based on the weekly regime probabilities, and now we're at real growth for Europe. So based on this, I think that there's still some price appreciation left, even if the overall economic situation without government spending is not that good. Even if I look at the signal strength, the momentum signal strength based on these factors, I actually get a pretty decent signal. So if the bars show it's 1 and it measures if the index makes higher highs. So the machine learning algorithm assessed this pretty good, in my opinion, and we're still on a bullish trend. So I don't see anything that maybe will change this in the next month. So I'm not that great on the short side for Europe at the current time. Yes, next slides you can see again daily CPI and momentum, as well as daily GDP and the implied momentum. So yeah, as you can see, CPI is falling based on the monthly mean by the market price, and we're below 5%. You can see the signal is pretty volatile. So it's a great directional view, but not as great for an exact forecast. And as well for GDP, we are currently at this is pretty decent. So we are currently at -5% GDP for Europe, but overall trending, it looks like that GDP momentum is up. So, and this tracks up stocks, even though we're at a pretty low level. And this sums up my view on Europe. So in my opinion, we're still having some price appreciation left in Europe due to rising rates and government spending supports GDP. Without that, the economy would have looked much worse. And yeah, that's for Europe. Yeah. Yes. Then I try to assess if we take the hypothesis that markets try to forecast the future. So there would have been a better correlation to the lagging GDP number. So I try to forecast GDP in 3 months with this model. And what you can see in this chart is the current state of the model, which implies in the green line a 1 month forward GDP value, and in the red line a 3 months forward GDP value. Even if we are getting some decent momentum in the last 3 months, the overall direction for GDP, if we try to model it, we can see that there's still a significant downturn in GDP overall. This would mean that we are in Q2, that it's likely that we're seeing a -7 to -10% year-over-year in GDP. But this heavily depends on, in my opinion, on government spending. Even if I don't like this point at all, but this is what I'm currently looking at the most is how are they stabilizing the economy? How good they try to slow this economic downturn and support it. But there's still significant risk in the market. Maybe from a price standpoint, not in next month. But if we move closer to mid Q2 or end of Q2, things should get pretty interesting again in Europe. What is a really interesting country currently is Sweden, because I've heard that some economists say, or some researchers say, that it's the canary in the coal mine. Because of the horrible data based on retail economic survey data, as well as in some cases industrial production. So what you can see on the left side is a second aggregates of multiple retail data time series. Try to factorize them and or try to construct a single metric. So what you can see is based in the red line, the retail data is it's horrible. It's at GFC level as well as survey data. What is holding up is industrial production in some cases and labor. So you can basically see it, the consumer gets wrecked. Labor is still strong. Labor is lacking overall GDP, or basically recession risk, and therefore you can see the development in Sweden, which brings me to the next point, that the recession probability for Sweden is really, really high. And it's really high not only in the survey, in the economic survey, but also in retail. We are seeing a rising probability in the stock market, as well as in labor, as well as in the industrial sector, as well as in the Swedish PMIs. And it's not nothing. If you look back at it, in some cases we're higher than in 2008 and 2009, and as well as in the COVID crash. So what I tried to focus on my Substack was the credit cycle, because private credit to GDP ratios with respect to government debt to GDP it's completely in a instability phenomenon probably. So, but there's even more potential that Sweden is going into a really deep recession in the next months, and that's why they say that's the canary in the coal mine, because it's a small open company. It's a small open country. Maybe it signals something for Europe, as well as the PMI has a great correlation with Eurozone PMIs, even leads it a little bit, and it's really a good test case for the next months if we look at Sweden, especially price action, which currently does not support this hypothesis. But that's what I'm looking. And if you look at the sectors specifically, you can look at the retail sector, which I'd like to assess within a Bayesian analysis. So you can see the mean, the lower and the upper bound, and with respect to GDP. And what you can basically see is that GDP is heavily mispriced. If you look at the lower bound, which most likely makes sense to look at based on the recession risk, then GDP could be priced at around about minus 4%, or -4 to -5% year over year. And if you look at this on the labor impact on GDP, you can see that GDP is holding is pretty strong, which is normal because labor always lags the retail sector or overall the economy, and you can see that the recession probability is not nearly as high as in the retail sector. So there's something brewing up in Sweden, which is pretty interesting overall, and maybe a great way to force some excess returns on the short side. And if we model this for based on GDP, I look at the most significant factors. The current nowcast basically on the monthly data, we're right below 0 for the GDP currently. And if I use a 12-step forecast with the Bayesian model, then we could see that it's already going down, and it's going down very as much further. You can see the lower confidence band is at it's below. It's at -6 to -7% year over year GDP growth. So this is really deep recession levels, and this is a pretty good bear case in my opinion. So even stocks currently do not price in the GDP numbers of probably -7%, which you can see here in this chart. So we're year-over-year stocks with its impact on GDP currently by prices in on the lower bound at -5. So there's some room left, and maybe due to the recent price action, there's something a good case for the short side. And lastly, I would like to show you some pockets of growth currently based on the macro signal, which is market implied. So you can see Europe, as I already elaborated on, Germany, which is really surprising with a 96.1% growth probability as a weekly mean. So maybe this explains the recent price action as well. Asia is looking pretty strong. You have South Korea, China, and Hong Kong, which are pretty good long side investment, in my opinion. Yeah, so got some strong long signals with some bullish classifications. Then weekly and monthly macro signal strength is also pretty high for most of these countries. So yeah, there's some investment opportunities on the long side. And that's pretty everything from me.
Thanks. Really interesting. We'll see how it will play out and what changes you will have in 2 weeks. So, Matt, it's been a while. It's been a while. So, what you see in the markets, what you're trading?
Yeah, hi. It has been a while. I've been skipping school, I guess you could say, lately. I'm pretty much aligned with Brian, I would say, and I'm not going to have a big lecture here because it's more or less in the same boat. I may have been in the short camp a little bit longer than Brian. I have been long the dollar, short the euro, which I ended up holding the bag, but have then come back. Based on what I saw with my analysis of real yields, which are really hard to calculate beyond a monthly calculation, I never went long gold other than a trade for the most part. I've been short gold via GLL for quite a while now, and I'm doing pretty well on that position. And I'm going to continue to hold that. I reduced it a little bit today just because gold's definitely shown a lot of weakness. So I'm more than willing to add back to that position, but almost at a 75% of max position, which my max position on that is fairly large. As well as I've also been short the 10-year via the inverse. Let me pop it up here because I can't seem to think. The inverse, which is TTT. And I have also been holding on to a short junk bond position for a while now and continued to add as it went down. I do see recession coming, and I do see that markets going south will almost guarantee that recession. They're always forward looking. So the other positions I hold are basically a lot of short positions. I had a bunch of hedges up through the last couple of weeks via TT or TQQQ and UPRO, which is the S&P triple leverage. And when Wifey and I believe it was Kerbos, who we probably all know from Twitter, indicated it was time to put some positions on in index puts and VIX calls, I did that as well, starting slowly at first, and then with every bump back to say VIX 17, 18, I thanked the market gods and tagged on another unit or two on the put side or call side for VIX. I've got it staggered out through the calendar. I do have some March. I've got a lot of June puts in both QQQ via SQQQ. So I'm calls. I'm sorry, calls on SQQQ. So I'm leveraging calls on doubly on that because I have a pretty good confidence. I'm not risking a ton. I plan on risking at most 5%. Right now I'm at maybe 2.5. So I've got room to wiggle if this thing wants to continue to start tapping the highs as far as the S&P goes. If it wants to continue up to 4,300, I'm well prepared, but I'm thinking longer term. I also am going to start adding September as we approach the March expiration in terms of, and only if VIX becomes cheap again. Otherwise, I'm going to be hands off and ride these positions. On the commodity side, I think based on what we're seeing is if indeed right now the economy is starting to move and the GDP estimates are starting to move up, and China is starting to become a growth factor on the global economy. I'm thinking that crude oil will be a good investment on the long side, and as well as a good hedge in terms of the service providers, et cetera. So I've been slowly nibbling on the long crude side, in addition to companies like Halliburton, service companies, Today I added a long position there. I'm going to keep those on a tight leash because if the market does start to crash or start to sell off, then nothing is safe, basically, whether you like consumer staples, crude oil, doesn't matter. They're all going to go down together. The ship will sink all at once. So I'm very bearish like Brian, and I've been that way for a couple of weeks. I think Brian wants to initiate a global holiday on February 2nd, the Global Capitulation Day, which we can all honor. The only thing that I would differ with Brian and where I'm being a little more cautious would be on the US dollar Japanese yen. It's had a good run. What I like to look at with that is that the Japan and the Bank of Japan is dead set on defending a 50 basis point 10-year yield. And right now we're sitting a little bit above that. And every time that it's threatened that dictate, they've come in and intervened really hard, and they do it over the weekend, basically, when nobody's around. And so that's where I'm being a little more cautious. I think that the US 10-year yield, I pulled back a little bit of my short on that today because it's run pretty hard. I'll add back to that because I'm definitely feeling short on this. I feel like the Fed is, Jerome Powell has completely missed this one, like he missed the inflation even beginning because it was transitory. So I think that the Fed in general is behind the curve now. I think they're going to have to play catch up. I think in doing so, they're going to completely shock the pivot crowd, which seems to be all in. And ultimately, the pivot crowd has a misunderstanding of historical bear markets, and thinks that the stage 2 that we're in right now is the end game, and it's a generational buying opportunity. And I completely disagree with that. We've got a long ways to go. We haven't even seen a recession yet. So generational buying opportunity usually occurs after layoffs are in mass, after interest rates are starting to come down and the Fed is starting to reduce, and there's still a delay factor to that. So we're nowhere near that. And I'll continue to add to my shorts. Like I said, I'm fairly heavily short. I've still got a decent cash position. So I've got a good war chest to deploy should the I would call them the normies continue to think that we're done with this bear market. And so effectively, that's where I stand.
Yeah, totally agree. Very interesting. So you said you were buying puts mostly for June, so it was basically like 4 months out, something like that. Yeah.
Yeah, I'm layering my puts. I have some in March. I started buying about a month ago. I started buying June as well, just adding little bits at a time. Anytime the S&P futures would tap 4,200, I would thank the market gods and grab another one. Basically, it's based on VIX. It's not on the S&P, but it's yes, similar. And then again, I think if we reach March expiration, and I'm in the money right now on almost all of my puts. If we reach March expiration, and the markets are still struggling to find a direction, or they're not continuing down, I'm gonna go to September on my puts, because I do think we're gonna have VIX over 30 for sure. It's gonna go into that bucket, and I think we may even have it over 40, because the shock after people realize that they're underhedged and leveraged long, it's going to be a hard sell-off, and it's going to pound the daylights out of the markets and cause VIX to shoot up like a rocket.
Totally agree. It makes sense. Okay, Pat, nice to have you here. So what are your thoughts on the markets?
Yes, thanks, guys. Sorry I wasn't here. First off, I had to re-download Zoom. I don't use it enough. At any rate, can you hear me okay?
Yes.
Okay, very good. Christopher, I wanted to say before I start, thank you very much. Raphael shared one of your spreadsheets. I'm looking forward to you working with my fractal range and you guys working together. I like your model, the clarity and simplicity of it. So look forward to that. in terms of what I'm doing, it's not, it's not a lot different than probably not as bearish as Brian. Brian is really convinced right here, and he's done a lot of good work. So I certainly appreciate his thinking on this. I really watch it day to day, and a lot of what I've been watching lately is Dixie, and I look to my fractal range MFR, and I believe it turned yesterday from UUP turned to neutral yesterday, and Euro USD did February 10th went neutral. And I kind of compared that with just the simple charting tools and trading view. And really the way that I see it, yesterday was a real good day. It's been in this sort of, Dixie's been in this consolidation mode since, let me look at it here. It looks like early February 2nd or 3rd, somewhere in there. We've been moving until yesterday. We're pretty much consolidating sideways, which for me is good, because we're in a turn, like a swing trader, and sort of we're in a turn where we're trying to challenge this long-standing downtrend, and to have that push up right now was really needed, because it's the sort of thing with swing trading. It's sort of, you either make it right now or it falls apart. So that was a good sign yesterday, real good sign that it really looks like, knock on wood, it looks like it's going to be able to keep pushing through, at least so far, in my opinion. And that was a super hard downswing on the weekly charts. If you look at Dixie, from the end of the year, essentially last October to now, that was a super, super hard pullback. So I'm not used to seeing that, and not really used to knowing how the hell the market's going to react. But so far so good. It looks like it's taken a hard turn up, after that brutal downswing. It looks like, knock on wood, we're going to be able, it's going to turn here, and I hope it does. And I traded through January just like the rest of you guys. And okay, so the Bulls won that month. I did okay, but it's day to day for me, right? And not unlike the rest of you, I don't know when it's coming. I guess I feel a little more possibility of bullishness than Brian and Matt in the not so much in the near term. The near term, I really think we are due for this pullback, but over the next few months, I'm not as convinced. Especially Christopher, looking at your stuff, that there's economically, you see macro-wise, economically, you see a little more optimism than at least in some of the near term, from a near term aspect. So I look forward. For me, I'm looking at some of the countries, like in the looking for entry points in China and Hong Kong, Taiwan. I think you had on your list, Christopher, and what else? South Korea, of course. I think from the way that I look at them right now, timing wise for entry, I think it's still a little early. Let me just pull one up here and make sure as I say that. Yeah, but it's very close, very close. So those I'm really looking for entry on all those in the Pacific Rim, and feeling like that's a possibility. I have been expecting that we'd get a pullback for right in the US here, and I'm baffled by Europe and how strong it's been. And also that Christopher, that you see more daylight ahead for Europe, which is great for Europe. Just it surprised me. You think back about, okay, Europe's going to freeze, right? We're going to have no natural gas. Okay, not only is that off the table, but Europe is, you've got Lagarde being more hawkish. In Europe, the stock market is saying, yeah, here we go, right? And they continue to. So the world's an amazing place. And but I'll take it. I'm looking forward to you guys working closely together with MFR. And really, from my perspective, the macro scene, macroeconomic part of this has been so freaking difficult. You know, all the various people that we listen to, I get it. It's an unprecedented time. We went through COVID, all this money in the system, sloshing around still. Nobody can, you listen to what we're here about liquidity. We are all over the map on what everybody's talking about liquidity. Do we have, you know, where the hell are we? Does anyone have any idea what's going on? Whether we're contracting liquidity or no, we're good through the summer. No idea. I have no idea. So those sorts of things, Christopher, I don't know if that's I haven't looked as closely at your work as probably I should have, but those sorts of things are so difficult for the macro folks to seem to be able to get clarity on. Maybe I'm just asking too much, and you know, it was unprecedented what happened, what we just went through the last couple of years. So I just ride it one day at a time almost. Lately I've been using these looking at the breath indicators, trying to help there and see if that helps us just figure out where we are in the cycles. I kind of feel like with Brian right here that it's surprising that we're not pulling back already to me. But again, anything can happen. So I'm still trading. I'm trying to move away from it, but I'm really trading the leverage, the 3-time leveraged products, ETFs, and just do that each day based on the setup coming in. Then trying to use the tools that Brian has for gamma more. And I think that some of that's helpful, but even that, I think we're getting better and better at understanding how to use the various tools out there, but there's still big gaps in really knowing, you know, is zero, for example, zero DTE, is it real? How real is it? How much influence is it really? Etc. All this stuff, right? So I think the tool, we're getting better with some of those tools, but there's still big gaps in our ability to fine tune any of that to be able to do longer term, which is really what I'd like to do, is longer term allocations, and that's what I hope to do. Talking some of the stuff in the Far East, it seems until you just started sharing more and more stuff, Christopher, to me it seems like you add in the valuation component, which has been like a decade in my mind. The Far East has been a better value for a long time, and not that we do a lot of work on valuation here. It's mostly just trading, but if you added in that, generally speaking, I think the U.S. is due for a breather in long term, a sort of a multi-year sort of thing where we're probably not as strong as we had been the last few years. And if that is the case, and if they finally do start to rotate more towards the Far East and more towards emerging countries that have been quote unquote undervalued for years and years and years, I want to be there for a part of that, and less trading, so more allocation wise. So that's what I've been up to. Ideas on how to actually, there are some thoughts I have. I think everybody here's style is different. You know, I think, at least in my perspective, you know, Brian and Matt kind of run a long short, or at least my impression is a lot of long short, like a long short hedge fund, and then add in a lot of options where they can. And Raphael's looks for fat pitch, right, and loads up the bus when he sees the fat pitch there. and which is great. So everybody's doing it, and then buy's got different ways and different thoughts and different like the synthetic hedge fund, we're using the mixture of different ETFs based on his analysis. So part of what I'm trying to do this year is find the right mix. One of the things I really want to add more is get better at vertical spreads. I know it, I've done a few, but not enough to really know what the hell I'm doing. So as a personal goal, use more vertical spreads for me when I can and where I can. So I'm not sure if that's what you guys are looking for, but that's my update. Right now, I'm really hoping that the shit hits the fan here in the US. Because that's what I'm expecting. And I'm kind of surprised that we haven't had at least a pullback, even if, maybe mine's not necessarily thinking a continuation of this deep bear market immediately, but a pullback, like a relief pullback from January's run up. And, I have no idea how long these things last, but that's what I'm expecting. And I kind of feel like, well, if the bulls can keep momentum, if we get a pullback, regardless of how deep it is and how long it is, it won't surprise me at all if the bulls come rearing back here in the US for another bite at the apple in the next couple of months.
Yeah, we all hope that shit will hit the fan, but I'm not convinced about the big sell-off. And regarding Europe, freezing and natural gas, so funny enough, but I think that soon Europe will have a totally different problem. Soon Europe will run out of places where to store excess natural gas. So it's a totally different problem, which is, I mean, not the worst problem to have. So, okay, Raphael. So how your puts are doing?
Can you hear? Can you hear? Okay, good. Okay. So yeah, I'm actually less bearish than Brian and Matt. I mean, I joked today saying that basically we are doing day trading since the beginning of the month. I guess you will address this via regarding correlations and Earth, etc. So the setup is there. The setup is there. I will show you what I see, but I don't understand why it's not going. That's why I'm a little bit more cautious. So screen share. Okay, let's go to daily. So basically what changed since last time? So not much. We've had volatility crashing on the SPX. It's just doing the same, at least on the daily. On the Nasdaq, we have the same picture. Volatility is still crashing. Europe, don't get me started on this. I mean, so it's just the same thing, bullish.
CAC all-time high.
Yeah, it's insane. I mean, but Chris addressed this. I mean, they are just throwing money left and right. So I can see that in my wife's company. I mean, they are just giving money for free, and they have no idea inside the companies how they're gonna survive because there are no orders, but they sure have money from government. So I don't know how long it lasts. I remember Vi told me last year he's not expecting anything before Q2. Seems like he was right. So you can see volatility is just crashing. This is a blue line. It's just crashing. You can see on MFR, everything is bullish. Before going to MFR, I'm going to address all the tickers I usually address. So DXY, actually, so we had the crash in ball that we are all expecting, and now we're basically at a trend. My assessment here is that there are two scenarios. So one is we just keep rising and we switch to bullish trend, and DXY just keep going higher as people unwind their short US dollar, long whatever other currency, especially the euro they have on. Another possibility is actually that we get the trend to go down with the price. So you would have the price basically stuck to trend and going lower and lower and lower until we finally get trade above trend and then a firm bottom on DXY for the next leg up. I have to say that I'm favoring this idea rather than the straight push higher for dollar. One thing that makes me think this is a preferred scenario is the long-term upside on longer-term range that we are seeing in MFR. They are, like you said, they are not moving. Trend is very hard to recapture. It's been a few weeks we are going higher, but it still hasn't recaptured it. So I'm not that bullish on the dollar until I really see this trend change. So we've seen some encouraging stuff like her strengthening. The price action was going higher. But yeah, I don't think the work is done yet. So your USD also, at least on my signal, hasn't broken a trend. And what I would like to see is actually a break, then retest, and then the move. So until I see that, I'm still, how to say, I'm not unloading, I'm not adding aggressively, but I'm waiting to see confirmation. We got the vol trigger that we were hoping for. Basically, trade went to min, vola trade went to min, and then of course vola increased and we got the sell-off. So that was expected. Now the problem is the continuation. We need to see continuation. Another thing that I have addressed for many weeks and finally happened was gold. So we went to min on vola trade, and finally volatility skyrocketed and we got the sell-off in gold. It's interesting because I'm starting to see some interesting signal on the matrix, for example. It's getting extreme, but vola has not reached the prior top. So I'm not saying I'm going to long gold, but I'm considering at least I'm watching it very carefully these days. Best would be to have a buy signal on it. So I show you my script. So yeah, I would like to see a buy signal like we've had before, at least to make sure I'm not buying a falling knife. The argument about real rates going higher makes a lot of sense to me. That's why I'm very careful, especially usually when you get this kind of compression on vol and you get the unwind, it takes a lot of time to repair. We've had this for the dollar, for instance. We had the same setup and look how many months it took. Platinum was the first one to go. It was the canary in the coal mine. You remember it was the first one to go. It just ripped higher. Volatility on this one is actually quite high. It's reaching some of the higher value I've seen to get some kind of decent bottom. So of course I'm watching this one to maybe lead. This one actually triggered some buy signal recently, but yeah, I'm waiting because gold will show. Silver did the same as gold. We got the spike in vol. We got the crash in price. So for now, I'm not touching those. Real rates still rising. No reason to try to catch a falling knife. So I'm waiting. Especially my thinking regarding macro is a little bit different. I'm actually in the camp of inflation. It's been like this since the 2nd of February. And I'm thinking what will trigger the sell-off is actually maybe the Fed reacting wrongly to this inflation getting out of control, triggering some kind of stagflationary sell-off. So I'm watching gold, especially for this, because I'm thinking if we get a stagflationary risk of sell-off, gold should actually indicate that we are near. Basically, I would expect a bottom in gold to happen to signal this. Another reason I was in the inflationary camp was because I got actually gold to switch trend on my signal, and I went long here for a trade and loaded on Thursday because the trend was not there on MFR. And of course, another signal was the big move in yields. We got the buy signal in move right at the bottom. It was same day as US 10-year was actually switching trend. That was just perfect. So, and I'm seeing the economic data actually improving, at least from what they are publishing. That's why I'm a little hesitant to go full bear right now. The one thing that is keeping me in the bear camp is actually VIX. So VIX, what we are hoping for was actually the confirmation that the vol of VIX was crashing. This is what we got. So I explained this setup numerous times before, and for now it looks like VIX has bottomed. So it's been a good place to start buying puts and and to actually buy some VIX long product. But yeah, the problem is what I've been amazed by is the fact that usually when you get this kind of price action on the volatility of VIX, VIX should actually be somewhere in the 25, 28 area, and we've not seen that thus far. And I don't know why. I'm very surprised by it, and this actually triggers my brain regarding the fact that maybe it's not the time to be that bearish. So we got the setup. It's just not skyrocketing like it did in every time we had this kind of setup in 2022, right? I mean, the setup is the same. We got this, but where is VIX 30, right? It's not there. So I don't think it's going to play out the way people think. I think people underestimate the fact that maybe the economy is more resilient than this, and that maybe the trigger will be actually the Fed having to over tighten because of inflation coming back. So this is my thinking right now. I'm unwilling to commit because of this. What else? What can I show you? Yeah, I think we're good. I mean, I think I've addressed all the points I've been looking at. Maybe later, if there is some questions regarding VIX, or if Brian has some question regarding the signals, I can address them.
Yeah, and also Raf, monitor YouTube chat. Maybe we will have questions, maybe not, just making sure. Yeah, and regarding VIX, yeah, I also don't know why VIX was always so low, but I don't care, because every day I was just looking at range on VIX and it said that VIX will not go up. So that's all I needed. Okay, so now today I will be a party pooper, most likely. So I also think that during the next 2-week period or maybe more, market should be lower, but I'm not very convinced about the big crash. I mean, big fast crash to almost new lows or so. For me, we are still in a chop territory, and I will try to explain why. So first of all, 3-month Hurst exponent on things like SPY, for example, was falling for the last 1 month. For a couple of days, it went a bit up, but but still I need to see some other signals. So for 3-month Hurst exponent, my level is 70. Everything below 70 is not really a strong trend. That's how I think, but I will show a historical chart in a minute or so. But basically now still Hurst exponent, real-time Hurst exponent for now is 0.66 on SPY. But for example, on IWM, we have like 73, and some others have even higher numbers. So I want that Hurst exponent to go up more, but that's not the only reason, of course. But Raf, before the show, also said, oh, you know, it's a day traders market. And yes, based on Hurst exponents, at least the way how I use Hurst exponents, it's been day traders market for months. So I really want to see signs, and I hope that it will be soon, but I really need to see signs that we are out of this day trader market before I will be willing to change the way I trade those markets. And the way I trade those markets is I almost never have overnight exposure because for those reasons. So now SPY 3-month Hurst exponent. So what I wanted to show in this chart is basically a rolling 3-month Hurst on SPY, and I put this red line at 0.70, which is just the way I view it. But yeah, of course, Hurst went up compared to where it was in January, but still, this slope is still going down. So before we approach the stronger levels, one of the signals will be Hurst exponent, especially 3-month Hurst exponent going down, because now we are in a chop territory, and for me, it just basically means that those people who don't trade on a daily basis, and of course, I don't recommend anyone to be day traders, but for those who are not day traders, this market is, I mean, there's no business in this market right now, at least for me. So this was based on Hurst exponents. Now, another thing, and actually this situation is there for more than a week. So why I don't like shorting here from a signal perspective is one of my favorite metrics on how I view MFR signals, which is basically a simple upside downside ratio. So of course it's available on an MFR, and it's very easy to calculate, but basically for things like QQQ, SPY, IWM, and so on, we have very ratios that are very skewed to the upside. And for now, at least my models say that, yeah, even though we are in a chop regime, so it means basically risk to both sides is very likely, but for now risk is skewed to the upside. So and of course trends. And we can see that most things that have bullish trends now has a positive upside downside ratio, and not a lot of short as well. Only XLU maybe, but I have other reasons why I'm not touching that. But basically, well, and that reason is that I want to go long, but not short. But of course, I never do that when signal says otherwise. Yeah, but this situation, for those who noticed, this situation lasted for quite a long time. I mean, positive upside downside ratio on SPY, and I need that to change in order to initiate some positions. And actually, 2 weeks ago, I initiated a position in dollar just because of that, because finally, well, not just, but I was waiting for a long time, and finally upside downside ratio was there, and that's why I initiated that. And it's still almost the same, but slightly above one. but the situation with longer term ranges, of course, confirms all views. So agrees with Brian and others, and nothing changed. I'm still very bearish because, yeah, on longer term basis. Basically, now the question for me is the timing, and timing, at least from my perspective, is not there. Because longer term models all say that basically the only thing you need to do is short the market, but timing wise and especially in chops, timing is very important. Timing wise, I'm still not very convinced that maybe that today was that time. I hope I'm wrong, because it's not about, for me, it's not about, you know, shorting at the highs or buying at the exact lows, because it's not possible for me. It's just process. So even though if I'm late to the party, I will only act when signal agrees with me. So longer term, this chart has the same title, I mean, but this chart is longer term range. So just in case, so that one supports me. Also, same situation with momentum, and also I never go against my momentum score. So 30-day momentums are still positive for those things that I would like to short. So of course, IWM, QQQ, SPY. Even though on the last hour of trading day-to-day, signals got a little bit better, because I tweeted like 1 hour ago, 1 hour before the close of that correlations risk is very low. And yes, it's relatively low, but during the last hour, correlations went a bit higher. So still not extreme, and risk is not very, correlation risk is not very big. But yeah, during the last hour, situation changed. But yeah, those scores are positive, and yeah, of course. So XLU, XLV are totally negative. So for some spreads, especially for XLU, IWM, those signals are not in the right direction, basically, still. And 5-day, that one is very reactive, of course, because the shorter the period, the faster it changes. But still, I mean, those values that are close to zero, I mean, I call them neutral momentum. So on a short-term basis, momentum turned to neutral on SPY and on QQQ, but small caps is still strong. And this chart was, I created the chart like 1 minute before the close using real-time data. So today for small caps, even after today on a 5-day basis, the momentum is still moderately bullish. So yeah, that's what I'm looking at. And now also I wanted to show you another thing. I was already talking about that, but how I view volatility metrics. So of course it's regular my fractal range this as a percentage. So I mean, it's range high minus range low, and you divide by the price. So it's also very easy. So it looks like it maybe wants to go up, but for now also all those probable scenarios are still in a choppy range. So also VIX is very low, volatility is very low. So I know that usually for other people, my process can look like, you know, if I wait for majority of signals to agree, I will be late to the party, but it's usually not the case. So I still think that when volatility is low, yeah, unless you are trading options. So if you want to make bets with options, I mean, buying options, so like Meta and Raf did and so on, yeah, maybe it makes sense. But for the strategies I like, low volatility usually means that shorts will not work right. So I will wait for the confirmation on that. So my game plan is this. I'm very bullish dollar. I'm really bullish dollar. So I'm holding a dollar and don't plan to change my mind in the short term. I still think that if we talk about medium or longer term, that dollar will go maybe even higher than it was in the cycle. So for a lot of macro, I don't agree with a lot of macro people that think that dollar topped. No, I don't think so. So yeah, I'm really bullish on dollar, and I really want to short equities, but today was still not the time for me. And we'll see. Maybe after 2 days or 1 day or so, those signals will change. But basically, that's what I'm looking at. Of course, trends, Hurst, upside downside ratio, and overall volatility. What is going on, and then relationships. So regarding correlations. Last 2 charts I prepared. Also, this was made like couple minutes before the market closed. So this one is 30-day average correlation to SPY, and yeah, it's relatively low for the cycle. Of course, not as low as in this area, but it's still not going up. And 10-day correlation, it spiked. So I really like that, and I'm looking forward to see what's going on, what will happen tomorrow, and then maybe the overall situation will be more clear. But again, based on price action in this regime, I'm still not really convinced that I'm still not convinced that we will have a very, very fast move down. And based on my overall views, maybe I even hope that I'm wrong. But still, today I was not pressing the button because I thought that based on my signals, I need to wait. So yeah, that's it for me. Party pooper maybe, but hopefully I'm wrong. So anyway.
Hey, Vi, what are your views of like what Raphael mentioned, what I mentioned about the long-term range in the dollar, and then related to the long-term range of the gold? Like, what do we need for that to get us back to the all-time high on the dollar?
I don't think that the actual range is what we need for us to go to all-time high, but first of all, what we need to see is monitoring short-term and medium-term momentums, and when those momentums start strengthening even more, it's a good sign. But for now, from managing risk perspective, if you want to actively manage dollar and not just like because I said, okay, I'm bullish on that, so I will hold. But if you want to actively manage that, watch short-term changes in momentum. But what needs us to move dollar up to the all-time high is, first of all, we need to move to a really, really strong risk-off scenario in equities, and of course, we want to see even worse situation inflation-wise, which I think will happen. But yeah, but it's not about the overall range. Yeah, overall range just that tells you how probabilities are skewed, basically. So and for timing wise, yeah, but correlations, inflation, and risk off in equities, basically.
Yeah, I think.
And to be honest, to be honest, I think that this time, if we have really, really big crash in equities, the dollar will rip very fast. We'll see.
Yeah, I think I would say like the long-term range matters less about how high the dollars can go and more potentially the idea that this isn't the big crash, because then dollar might put it in a short-term top if it gets to the long-term range. Yes. But yeah, no, I'm with you on like not really trading the dollar. I just like during the November to January move, I just sized up huge, and at this point I'm just like waiting. I'm just holding it until I see the crash, really. Like that's like dollar, and I'm treating XLU IWM the same. I'm just like kind of holding both at this point. And those that might be the only positions I don't cover or trade around, really.
And for short-term timing wise, when I don't have any positions but want to initiate some, if I had to choose one way how to view the range, it would be upside downside ratio for timing wise. Not the exact level, you know, tick by tick, but upside downside ratio. Because you want a signal to tell that there is higher probability of you being right than compared to the probability of you being wrong. That's it.
Raphael, about that daily VIX not being high enough, how do we get to 34? Do we just have to gap up tomorrow and just make up room in volatility, or is it just not possible?
I mean, the recipe, the ingredients are there. The ingredients are fucking there. I don't understand why it's not ripping. I mean, it's based on what it did in N21 and the whole year 22, it should have ripped. So my guess is the people short vol are really are back, and they are really big. So maybe that's the reason for now volatility is capped. But I mean, they are playing against the tide. When will the tide move? I don't know. But Matt mentioned that he's buying puts every time we go below 18. I think that's definitely the play. I mean, 18, even below 19. I mean, it's just very cheap. Very cheap, very cheap. So I mean, why not do this if you can manage your positions along the way? So yeah, the problem is we cannot have a sustained move. I mean, I can show you another thing I didn't show before, because, like I said, we are in this. Wait, how do I show this? We are in this day trading environment, and it's been working pretty nicely so far. To day trade the positions should be this. Sorry, yeah, it's so basically what I'm looking at. It's I'm doing the same thing I do with the daily vola. I just put a min where trade of vola goes, and when we reach this level, so basically on the US 500 it's 0.5, and I just take a short. I wait for volatility to rip, and I get out. So for now, it's been working nice, right? Every time we go there, volatility rip, you take off. This morning, pre-market for Europe, it was in the morning. Just take it, and then you wait for volatility to rip. So I would guess tomorrow you take it off. The issue we have now, and that's why I agree with Vi, with the fact that we are in the chop environment, is for now, the spike in vol is not followed by a big crash in price. We used to have like at least 2.5, 3% down move when we had this kind of volatility move. For now, it's very contained. It's like minus 1%, minus 1.5% move. It's very low, especially considering the macro hit we keep getting. CPI, PPI, this should have triggered a much wider move, which we are not getting for now. So yeah, just adding some more on what Vi said.
Yeah, I can also share one chart, but sometimes I hope that I'm wrong. So yeah, but for tomorrow, top end is like 22 only. So maybe VIX will break it. I don't know, but here is a historical chart of a MFR regular range and VIX. And this chart is made more to see how ranges perform and how price, whether it stays within the range or not. So it means price of VIX is real time, and range is end of day. So these ranges were basically what we had for today. It's yeah. So price closed almost near the top end of the range, but for tomorrow I already checked for tomorrow. That upper range went only slightly, so 21.9 for 22, 21.9 basically. So So I don't know. I want that also that upside in the ranges to go up, because for now it's still not there. But yeah, basically I hope that it will not be as it usually happens statistically in a while. If it reaches very close to the top end of the range, I hope it will not go down tomorrow.
Do you have a lot? Do you have the same picture in your long-term range value?
Yes.
Because I'm curious, because we've gone I think we've gone the longest without a real spike in VIX. Like the highest we got in VIX was 26, not even 26 on December 13th. We've gone so long without a VIX spike. I think we've gone even longer than we did in some of the bull market, like definitely longer than 2021 when we were getting VIX spikes every month. So it's like, I guess the near term range right now, and like the way I'm thinking about it is just, we've gone so long without a big move to where I guess there's not really data that's being factored into a big move having happened previously, right?
Yes.
So, you know, one thing I noticed this week, VIX flirted with going to neutral trend. It actually closed at neutral trend one day, and then it started, because I think we've been going flat for so long. We get any kind of rip beyond today, your trend's probably going to change, if I had to guess, like soon.
Yeah. So this is the chart if you want to see.
Yeah, there you go. So it's like even the top end of the long-term range is near the lowest point it's been for the entire bear market.
Yeah, basically, yes.
It's wild. I mean, it also shows, I mean, people have dumped puts. So like, you know, the idea of March vol event concept, it's not out there. Like it's not too crazy. Like people have absolutely dumped vol. Like February 2nd, it was the cheapest on a fixed strike vol basis, not just VIX. The entire bear market, you got to get the cheapest puts out there. And I was going, but people on there were being bullish and talking about not buying puts on February 2nd. I'm like, we're still in a bear market, and this is the cheapest vol you can get the entire time.
Yeah.
You know, so it's like these options guys that are super smart. That I'm simple. I look at IV rank. It was the lowest point for the entire bear, and you're not buying puts. I don't understand.
Yeah, I agree. Yeah. I rarely buy options directionally, so my thinking is a bit different. But exactly, I look at IV rank, for example, when I want to open iron condor. So I look at IV rank, and if it's not high enough, I say nope. Okay, not today. No. Yes.
There are two questions. One is why, by saying holding dollar, do you mean cash or T-bills?
For me, it's cash, because for me it's already a trade. For those people who live in US or where the main currency is USD, I think there are other better options. T-bills is one of them, of course. Yeah, but no, for me, I use interactive brokers, and I just, you know, you hold different currencies, and I take my euros and convert them to dollars. I mean, but it's very funny because I can have no positions, but my P&L will move every day because my base currency is euros, of course. So, yeah, but in my case, it's USD.
Another question, and it's more for, I would guess, Brian and Matt. It's do you have any bullish individual stock picks to hedge your bearish macro bets?
Yep. I'm running one spread right now that I've been held it through its earnings report. It's a long Pepsi, short XLV. So I am actually, there are some names I want to try and hold into earnings on the long side. Especially some of the defensive names that have gotten like completely decimated. Like I'm actually looking at potentially Walmart on the long side into next week. Maybe, I don't know. I'm not quite convinced on the discretionary aspect, but I'm looking at like Walmart. Let me look at my list here. Walmart, Costco, Nike, RH, but that one will continue to get hit. But that's like my, you know, I subscribe to some of the retail guys out there. I'm a big believer in RH in the long term. So I'm looking at, potentially getting into that one at Lowe's, Domino's, Hershey's chocolate, actually bullish on Facebook. So I'm pissed I missed this. I actually knew it from a macro perspective. I just wasn't really thinking on a spread basis. But if you had longed Meta, short Google, Meta over Google, when it blew up on earnings back in October, would have been probably one of the best trades anyone could have made. That spread doubled and more. Actually doubled. If you longed it right after it blew up on earnings, long Meta, short Google. So I'm actually looking potentially to get into that one. Right now, I'm just heavy short Google, but maybe after we get a blow up and there's potential for some bullish side, I might go long Meta, short Google. And but yeah, right now I'm running Pepsi XLV and then like Vibe, bullish on XLU, so XLU IWM. And then the spreads I was looking at, if I was going to go, I was thinking about long Domino's, short Wendy's, and then long Walmart, short Target, and then long Nike, short Under Armour. But only longs I'm doing right now, if I do want to try and run, the spreads worked really well, especially Pepsi XLV. I was really happy with the way that worked. I would only do it in a spread. So that's the way I'm looking at it. Trying to find pairs like that work well.
Matt, no?
Yeah, I think I mentioned earlier that I've had one long that's worked fantastically, but I would not enter it right now. It's ELF, which is like a beauty supply store. Those, for whatever reason, like Ulta Beauty too, has been just outperforming everything, and apparently everyone's loading up on face paint. But beyond that, I also have some restoration hardware, DECK, DECK. And today, I think I mentioned I entered a small long with two small longs with tight leashes. One is in Weyerhaeuser, because I'm basing that off of the lumber commodity, the futures. To me, my technical analysis, the old school analysis, looks like lumber may have bottomed, and if indeed we're going to have this takeoff of short term where GDP increases and economic activity increases in the US, then that would probably support construction spending and therefore lumber prices. So I went long Weyerhaeuser. I'm also mildly bullish on the oil services sector. So I did go long Halliburton, and I'm also holding some XOP, the services ETF. But small positions right now. They're just basically hedging me for when my shorts get hit. These usually attract something on the other side. So it'd be probably better for me to reduce my short exposure than just adding more positions. But I'm fairly comfortable with these and feel like they'll be okay.
Let me actually let me rephrase one. So I did say long Domino's, short Wendy's. I was actually just thinking about it. I'm really short Chipotle, CMG. Super bearish in Chipotle. I wrote it from the earnings report, and I'm short that one outright right now. So now that I'm actually thinking about it, since I kind of want to get long Domino's, if we start puking here and we get to the point where we might bounce, I might put Domino's opposite Chipotle. So that spread's bearish trend right now. Domino's, Chipotle is bearish trend. Pepsi XLV is moving a bullish trend. It was bearish when I put it on. Raphael, your script helped a lot with that one. Walmart, Target is bearish trend. So I actually, these spreads, I don't have like the hourly on TradingView, and I don't have them plugged into like my signal strength things. So the way I'm approaching them is I'm kind of like just waiting to maybe the long-term upside downside just gets really nice on that spread and it's bearish trend. And if it's a good time, I think from a market perspective, I might just throw it on then. It's kind of the way I'm thinking about it. And I'm not really trying to trade these spreads. So I'm thinking like I put XLU IWN on when the long-term upside downside was really good. I put it on too early. Now it's just kind of goes sideways, sort of confirming what that long-term upside downside ratio looks like. And so I'm just waiting on it. I did the same thing with Pepsi XLV, and I had a catalyst with Pepsi. I wanted to hold it into the earnings report. So that's kind of the same way I'm thinking. Like Nike reports next month, Domino's reports soon, and Walmart reports next week. So the Walmart Target thing might not happen. I don't know. People are bullish on Walmart because it's more of a consumer staple thing, but it's still discretionary in retail in a lot of ways. So I'm just not that convinced. But yeah, that's it. Thinking about Domino's, Chipotle, cheap pizza over expensive burritos. Although they are offering free queso right now.
Okay, so no silver miners.
No. In fact, one thing I'm also not. People are really bullish, same way like everyone was talking about buying the bottom in bonds, buying the bottom in gold, buying the bottom in gold miners, generational buying opportunity in gold miners. They're also really bullish on China. And they all look the freaking same in your script, Raph. Gold miners, China, they all look exactly the same in your script, and they all behave exactly the same in the drawdown too. Like someone was asking me, are you bearish on China because you're bearish on spies? Like I'm bearish on China because I'm bearish on gold miners. They look exactly the freaking same. They both need dollar down. They both need real yields lower. And yeah, I think China gets whacked. Wifey thinks China's going back to the lows too. I know that, right? That was in this Q&A thing. So yeah, I think just like everyone got bullish on gold at the top, everyone got bullish on China at the top too. It's just like that. I mean, I get the idea of the whole international stock, but if the dollar rips, all the international stocks are going to be worse than U.S. stocks too. They're going to get pounded. There's no edge in, like, if the U.S. isn't going to work, like I don't see China in this raging bull market. It's correlated. They're all stocks. If the U.S. market crashes, China is not going to like miraculously put up green on the day. It's just not going to happen. So it's like, what's the edge there? But I was looking at like K-Web over QQQ potentially, long K-Web, short QQQ. Ooh, that one actually did put a buy in your script. So I'm actually taking a look at that one. That one's bullish trend in MFR. Oh, no, it's bearish trend. And actually, ooh, okay. So maybe I will be long China. K-Web over QQQ has a good long-term upside downside ratio buy. It just put a buy on your script. So there you go. Long K-Web, short QQQ. But I just still don't, like, I don't know what the point, like China could blow up just like the rest of the stuff out there. It's like, I'd rather just do a US stock versus S&P or something like that. So I don't know. China's going down either way. So K-Web versus QQ would be like K-Web maybe goes down less than Qs or has some updates along the way or whatever. So that's where I'm at.
Yeah, K-Web is kind of okay now in daily, and it's actually trying to reclaim bullish trade. But the problem is if you are bearish on US, K-Web is gonna get whacked anyway.
Yeah.
So,
Yeah.
I mean,
and you got all kinds of geopolitical stuff about the US just trying to do everything they can to make China seem like their enemy. And so they could try to delist all their stocks. Like there's so much blow up risk there. It's like, what's the point? Unless you're like trading some of the individual names for like a rip here and there during like, I mean, like if you had long China back in October on the collapse day where it just absolutely puked and was capitulation, I mean, that was a good trade. But here's the problem. Everyone got long China, got long gold, got long bonds, got long gold miners, and we're banging the table on them in January. Like that was the top. Like, and all the liquidity guys are all bullish on liquidity here in January at the top. Where were they in October before all of it happened? That's my problem. They were all super bearish from October, November, December. And then now they get bullish on bonds and gold miners in China in January. I mean, come on. Like China buying on the day when everyone thought it was uninvestable. That was the play. And your thing had a bunch of buy signals on that, Rap. I didn't go for it, but that would have been a great trade. And then now you'd be out of it.
Yeah.
Yeah. And bullish, they're bullish because they're China reopening on Europe in January. Where was that bullishness in October when the CAC was on its ass and now it's at an all-time high?
Yes.
You know, that's the problem.
Yes.
So much stuff is backward looking. All of it's so backward. Where is it going? China's probably going to puke from here.
Yeah, some stuff in France. I mean, some stock I'm watching. I mean, they are more bullish now than they have been in their entire history. I mean, I can tell you, for example, some French banks. I mean, one of them, the trend on vol is the lowest it's ever been. It's like, why? I don't understand. So I've been waiting for it to just this thing is going to explode. I mean, when Europe tanks, so I would guess European financials are the same, right? But French banks are going to it's going to be like, because the volatility is so compressed, it's really, 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 really low. It looks like tech stocks during the 2008-2009 bubble. The volatility is like this, and the numbers are atrocious. I listened to the call of these particular French banks. It was up 6% on the earnings, and they actually posted I don't know how you say number in English. The results for last year, it's minus 15%. I mean, what are they buying? Like 2025 results?
Well, they were expecting minus 50 then.
Yeah, but it's. I mean, the Schwab is having fun with the monkeys are in charge, and it's basically this. I mean, so yeah, I mean, we just wait. I mean, we just wait. This thing is gonna hit sometime.
Yeah, there is one question, but Brian already talked about it. So Michael Ball, I recommend you watch the video, but basically from the beginning, but basically the question is not much said about yen. Any thoughts on USD cross? So Brian, you can give a very short version of what you said about bonds and yen. And
yeah, I mean, like I'm more deferring to the trend on yen. Actually, the one thing you said, Matt, about like that they don't I mean, I think that if the Japanese central bank, and I'm not a Japanese central bank pro person, I'm not going to pretend like I am, but in a simple manner, if they're going to stay as dovish as possible and they're going to keep that thing going beyond 50, that would hurt their currency, I would think. So I would think if they're going to stay dovish, I mean, one of the reasons that yen ripped off of alongside the dollar kind of falling over back in November, which of course one called then, but they're all bullish on yen now, was like the move from 25 cap to 50 cap, and they were front running that, and then it happened and it went a little further. But since December, we're now coming back, and so it's just, I think it's just a matter of the Japanese central bank, as far as I can tell, they're not going to change and be just extremely hawkish right now and protect their currency. And so you just have the Fed versus a stable situation over there. Stable is in like they're not really doing anything. And so dollar yen is just going higher, and that one's led the entire Dixie move. It was the first thing to move. It's more the euro that's lagging. So definitely wouldn't be buying yen here. And I put a video of one of the Real Vision guys who's just super bowled up on yen right now. He's talking about the fact that if US growth has to be, and all the macro guys, they say repriced, it just went up or down. Like repriced is really a way to sound fancy, but if US growth is going higher than expected because everyone was pricing in this immaculate disinflation / recession where the Fed is going to cut rates right now, then the yen is along if US growth has to go higher. It's completely false, because that means that if US growth is going higher, that's going to strengthen the dollar, which has been on its complete back, which would pressure the yen, and it would hurt bonds. So no, I definitely wouldn't be the yen right now. I kind of wish I shorted it, but I'm just long UUP, which gets some exposure to that and the euro. So
Bitcoin is getting nuked.
Bitcoin's getting nuked?
Yeah, at least the 25K was not the price to buy it.
Yeah, the last they're trying to hold it up into the close. Yeah, that's 24.
Yeah, I actually doubled the buy to put on this move to 25K. I mean, this just what are they doing?
March or
I bought some March and also some June. So just to be
June, yeah. Now June makes more sense. Yes. Okay.
Okay,
so
good.
We're doing any bets?
Yeah.
The
dollar
bets.
bets.
Yeah, the bets last time. Let's celebrate.
Oh, how'd they go?
One was if Euro USD was going to go above 1.11. And I remember
a lot of people said yes.
Ted was very bullish on the Euro. So I guess that's why he's not here today. And who else? Oh, Christopher.
Yeah. As
But
well.
yeah, the all other, yeah, we said no. The other one, it's because we had a false flag at some point. It was oil bullish or not, and we said no. And I think USO switched today, but I don't know if it held at the close because it switched. USO switched bullish, but I don't think it held. And we all said no, so I would count that as a win. And as far as the bets. So 2 weeks, right? 2 weeks from now.
Yeah, kind of.
Is the dollar bullish trend?
Okay, let's go with this one.
Yes.
I say yes. Looking at the UUP MFR trend as the indicator.
So why?
Yes, I'm saying
Right. Matt is gone or is still there?
Thumbs up.
Yeah. Okay. Everybody is bullish or not?
Haven't heard from Christopher.
Yeah. I think I would say
Pat?
kind of short time frame for me.
Okay,
so-
everybody's bullish.
You say still disinflation currently, so would make sense to switch back to bullish.
Yeah, I'm really hesitant. I'm gonna play contra. I'm gonna say it would not have switched. I'm gonna go with I think it's gonna go neutral or and stay there. So I'm gonna say no. I'm the only one. Even though I'm very bullish on dollar, I also agree with Vi. We're gonna go like crazy. I just don't think for now, but I hope so. VIX or price
Yeah,
of
VIX.
speaks lower or higher than where we are now? Something
No,
like
how
this?
high does VIX go?
Okay. How high VIX go in 2 weeks?
crazy people.
Yeah. So higher or lower?
Higher.
No. Pick a number.
Okay.
Damn. 26.
Wow.
I wanted to go higher, but we will not. My bet is we will not reach 30s in 2 weeks, so 26 can be a number, but it's just to express a view that we will go up, but not extreme.
Okay.
28.5.
Okay. Anybody else?
24.75. I'm going low, like the price is right.
I'll take the high with Brian. 28.
28.
That's bad.
We still have
also tend to go lower.
sorry.
I would also say 24. I think some forward returns, and if I look at this based on the regimes, it's in my opinion there's some positive forward returns in the next 2 weeks, in my opinion, on some of this stuff. So I don't think volatility will spike that high based on that.
Okay.
Based on the simple assessment.
So the question is, where will it be by the time we do the next show, or how high it would go?
What's the highest it gets to by the time we do the next show?
Highest. Okay.
Okay,
I'm going to revise my bid to 31.
I'm going to 24. Oh, Chris, yeah, same. 24. Okay.
Yeah, I switched to 31. Raf, make sure you write that down.
Sorry? I
switched to 31.
31. Okay.
I have no one freaking knows how high it's actually going to go.
Yeah, I know,
it's
and
ripping.
we don't care
course
about the
not.
bets
It's
anymore.
ripping now.
There is a quick question if we still have some time left.
Oil.
Any thoughts about oil? Because for me, I will say the same thing I was repeating. that my thought is this: I would not short oil. Now, I mean, no way. So I don't have a position. I'm watching, but I have it in a watch list of possible longs, but for now, no thoughts. The only thought is I will not short.
Yeah, I'm the same. I don't want to short oil. I don't want to short natural gas, and I don't really want to short energy stocks either. I'm completely lost. I mean, we're at the point now, oil has done absolutely nothing for 7 months, almost. Over 6 months. Oil has done absolutely nothing. I don't know. I think the fact that we're not in a recession yet, people aren't getting laid off. There's risk it rips. I'll go long if maybe we get like a really good spot on Raphael's script or if the long-term range is there, but I've stopped trying to short energy stocks. It hasn't really made money for me. It just, every time the trend gets bad and goes bearish, it just rips in your face. And they were kind of getting hit with, they were getting looped into the defensive sell-off that we've seen for a lot this year. So alongside utilities, staples, and energy, energy got sold off alongside that. So I think there's risk that they outperform or even bid. I was actually looking at XLE IWM. I don't know if you've ever put this one on or looked into it, but I was potentially looking at that one too.
Yeah, I never had a trade, but I have it in my watch list. Yes.
Yeah.
I'm thinking oil will rip. I mean, I like the trade and trend signal, but it needs to hold 74. If we hold 74, I think it's going to rip. Especially, you can feel that the US admin is very afraid with oil prices going higher. Every time we arrive at 80, they just unload their strategic stuff, strategic reserve. So you can feel they are worried about inflation going higher. So my guess is they will get what they want to avoid. So if we hold 74, I would expect in the inflationary panic oil to rip.
I will go with that. I think that if the US should continue to print strong macroeconomic data, and they also deficit spend, and they try to pressure especially OPEC states to keep prices pretty low, don't ramp up production. So then you basically have a situation. So for like the Saudis or something, that they could actually want to take a part in this so-called economic growth. If you look at quarter-to-quarter growth rates, so they are basically wanted to raise. So given by that US should print stronger numbers, it implies that maybe that we should also see a rip in oil based on this monopolistic pricing or pricing settlement, in my opinion.
Christopher, by the way, regarding this, we are going very long, right? It's 2 hours, but yeah, I mean, they can watch it when they want. But regarding the GDP estimates, I think it's Atlanta Fed. They are rising the I think it's quarterly GDP estimate, right? I mean, we went from 0 to something in the 2%, and now they are rising it. So how do you explain this from their point of view? And do you agree on what they are actually saying?
I actually agree. They're looking at quarterly numbers. So what I do is year over year and then GDP momentum. So it's a different approach. I showed this, if you backtest quarterly numbers within stock performance, is not that good for as a filter for positive stock returns. But they deficit spend. It's crazy. This supports GDP massively. This is a major thing. If you look at our funds model for GDP, it's if the deficit spend goes directly into the GDP now cost. So I don't know. I think they are at -7% the deficit spending to GDP, if I remember this correctly.
Yeah, it's crazy. They went from positive to really negative in 1 year.
Yeah.
So yeah,
this directly feeds
support.
also into the labor market. So that's why they keep these strong numbers at a steady rate. So yeah, they also, I don't quite know the exact methodology of the nowcast, but I think that they try to forecast into with some respect into quarterly end. They it's a Bayesian vector autoregression or something, in my opinion. So then you can see it's the nowcast is pretty volatile. Each time they update it, they try to feed every data point into it, and they have a second model in the paper, which actually forecasts it each of the time series. So, but overall, this it's pretty exact. So yeah, everyone should follow it.
Okay.
In my opinion.
There were one last question, and then we can close. I guess this one is for Brian. What are your thoughts on retail stocks? Because you are following this heavily now.
Retail?
You retail, yeah.
Oh yeah, super bearish on retail. Super bearish on retail. I think I some of the earnings were worked out already, some have not. The guy I listened to, you got some really great stock picks, can't get around that. So I like a lot of his names into the prints. Travel and leisure. I faded a lot of those earnings reports, and that was good decisions. Like Marriott, Trip, a lot of the hotels, they all had great earnings. So people are still spending on leisure, but retail not only has problems from consumer spending going down on them, that's not their bigger problem, are margins at this point, and they've been discounting like heavy. The holiday was just a dogfight, and especially with inflation picking up now, consumer spending on retail is going to hit even harder, and they're still doing discounts. So I'm super bearish in retail. That's the biggest exposure I have on the short side from a sector perspective. My top shorts that I actively have on the board right now are HZO. They sell yachts. I have Canada Goose, which is puffy jackets in Canada. I have Crocs, which I put on. Actually wore it into the earnings report today, so that wasn't great, but it gave back most of it into the close, so it's okay. I have Leslie's Pool Supplies, and those are the main ones. I'm really big in some of those names, so it's hard for me to add that much more, but of all the stocks that I model, retail is my biggest list of stocks. There's so many to pick from. I try to avoid the ones that have already worked really well, that are just now part of the meme stock craze, like until the drawdown really gets going. Names like Wayfair, I mean, I think it keeps blowing up, but like on the days where retail or like high beta crap rips, I mean, the thing goes up like 20% in your face. It's just like tough to deal with. I also have a rule that I've started to implement for single stocks. I don't go under $10. Under $10, the fills aren't that great. And it's just like, what are you playing for? And it gets looped into the big squeezes. So I like retail names that are over $10. A lot of the names I already mentioned are in the 30s to 50s. So I like those. Yeah, super bearish in retail. Super duper.
Yeah. Okay. So I think it's time to end today's talk. I hope it was useful. I'm sure upcoming 2 weeks will be interesting. Manage risk well. So thanks, Brian, Christopher, Matt, Pat, Raphael. Thanks everyone for joining, and see you in 2 weeks. Bye.
See you.
Bye.
Wow.